Good afternoon, everyone, and thanks for joining us today. Of course, with me I have Lakshmi Iyer, President and CIO, Debt for Kotak Mutual Fund, and today I think the way we are going to be doing this is that maybe to begin with, I'll share a little bit about what our views are, from a fixed income perspective, and then maybe for about 10-15 minutes, then I'll hand over to Lakshmi for sharing her thoughts on interest rates and how investors should position their debt portfolios. So to quickly sort of kick off, I think I'll just share my screen and we can get sort of started from there. And then towards the end, we'll take questions. So we have enough time for questions. So do feel free to post your questions in the Q&A box as such. So we'll take questions from there at the end of the session. Yep. So just give me a moment. I'll just share my screen. So yeah, I hope my screen is visible. Okay, I think it is. Okay, great. So obviously it just seems that we seem to be moving from one perfect storm to another, right? We had in 2020-21, of course, we had the COVID crisis, which impacted our lives, and obviously the economy and the markets and so on and so forth. And since then, of course, we had a recovery in the economies, I mean, in the global economy as a whole, and of course, spurred on by the central banks and by the respective governments in major sort of markets. A lot of liquidity was pumped into the system and so on and so forth, and a number of measures taken by sort of various sort of governments as well. So since then, of course, we've had, since probably I would say the second half of last year, concerns around inflation cropping up, and since then inflation has moved from being transitory to slightly more persistent in that sense. And of course, central banks have come into sort of action to try and bring down sort of the inflation sort of levels as such. So clearly, of course, the situation right now seems to be, of course, quite I would say quite different from what we've seen over the last couple of years, along with inflation concerns. Now, very recently, of course, you've had on the domestic sort of macro side also some concerns cropping up around the current account deficit sort of expected to widen quite significantly. The rupee also depreciating quite sharply. So we've just got more recently some of these additional sort of concerns that are also coming through. So we'll talk probably a lot more about this during the course of today's sort of webinar. Like I said, maybe I'll just kick off with a little bit about our thoughts on what's happening right now in the environment, and particularly on the fixed income side, and then I'd hand over to Lakshmi to sort of post that to talk about her views as such. So just before talking about that, a quick snapshot of the investment management group within Morningstar that me and my team out here are part of. So this group within Morningstar is responsible for providing investment advisory and portfolio management kind of solutions to end investors. And typically we offer these solutions by partnering with advisors, right? So that's how these solutions are offered to investors as such. And this team consists of about 650 odd people as such, out of which 90 odd are investment professionals. As you would appreciate, these are people whose day-to-day job is to track markets, build views on asset classes, and manage portfolios and so on and so forth. So a fairly sort of strong team in place to sort of provide these solutions to you and to your clients as such. And how do we, sitting out here, leverage our global experience and our resources as such? So the way the group is structured, it is structured into 3 regions: Americas, EMEA, and Asia Pacific. And within each region, a center of excellence or a hub has been identified. And all the countries within that region work closely with that center of excellence in a way to build solutions for the local market. So for instance, within Asia Pacific, we have a large investment team at Sydney in Australia. And we and other counterparts in other countries work closely with our Sydney investment team to build, Australian investment team to build solutions for the local market to monitor, different asset class views and so on and so forth. So that's a bit about the investment management group. And just quickly sort of moving on to in terms of what's happening right now, obviously one of the factors that has been driving inflation over the last, about year odd or so has been obviously, commodity prices, which have moved up quite sharply. So out here, obviously, as you can see, we sort of rebased, the major commodity group to Jan 2020 with a starting point of, at 100 kind of an index level. And, post, obviously, since the mid of, probably, Q3, Q4 of 2020, when, the recovery seemed a little bit more, imminent in that sense, and the vaccine discovery and all of that happened, commodity prices have started to move up. And of course, interestingly, of course, in more recent times, we've seen a dip in commodity prices. So, across, whether it's energy or whether it's, agriculture or food prices or industrial metals and so on, they've come off a fair bit over the last few months as such. And this is on account of course, fears of a recession and economic slowdown and all of that. And of course, central banks moving into sort of, raise interest rates. But if you still look at, if you compare it with the base of pre, pandemic kind of levels, at least, energy prices and food prices or agri prices are still up by anywhere between, 50 to, 70 odd percent as such. So, despite the moderation, prices are still, significantly, higher as such. Now, of course, on account of all of this, and not just commodity prices moving up, but, the strong recovery in demand, we've seen a resurgence in inflation as such. And out here, what we are looking at is how inflation has moved in major economies over the last year odd or so, and vis-a-vis the respective targets for central banks. So US, we're seeing, in fact, not just the last few months, but in fact since about May of last year, inflation has been above their own target sort of levels. And generally, we've seen that central banks, developed market central banks, have inflation targets in the range of about 2 odd percent or so. I would say probably barring China, where inflation is still below the central bank's target levels of 3% or so, and of course for a variety of reasons, which are slightly different from what's happening in developed markets, whether it's the lockdown measures or the regulatory changes that they made over the last couple of years, which has impacted many large sectors, particularly the technology companies and so on. And of course, in India as well, we've seen inflation remain above target levels for a good period of time, barring a couple of months during last year as such, where it was close to the target as such. And of course, this is what is spurring central banks to act. And clearly, the US Fed has sort of, in a way, of course, they've been criticized a fair bit for being sort of behind the curve, so to say. Initially, they were thinking inflation was transitory, and that is what the dot plot on the left-hand side indicates. So this is what the Fed officials were thinking of where interest rates would be over the next 2 to 3 years, and in December 2021. And you can clearly see how this has shifted over the next 6 months or so, from December 21 to June 22. In December 21, the expectations were that probably in the current year as well as the next year, combined rate hikes would take up the Fed fund rate up to about 1.5 to 2%. This was the initial thought process, but this has changed significantly over the last 6 months or so. And now, versus that expectation, now the Federal Reserve is expected to hike rates going up to about anywhere between 3.5% to 4% by 2023 or so. So clearly a significant shift in terms of the extent of tightening that is expected in the US, and probably several other major central banks are also following in a similar kind of fashion, although not probably exactly the same way. And in response to this, of course, bond yields have moved up, quite significantly, and particularly, since 2000, early part of 2021, we've seen bond yields across, major markets, barring probably at China again, which is the purple line on top. Barring that, most of the major markets have seen a spike in bond yields to reflect, these inflation fears and the sort of expected sort of hike in interest rates as such. And but of course, in more recent times, we've seen a bit of a moderation. So again, as you can see out here, bond yields, and this is the 10-year government security bond yield, in India as well as in other markets have moderated a bit. So they've come off the peak levels, in a way reflecting the fall in commodity prices, and also, concerns around, a slowdown in economic growth and probably a recession in the US, as such. And just, very quickly looking at inflation in India, and, of course, fuel and, higher energy prices have been a key driver for some time. But in more recent times, we've also seen, food prices sort of move up sharply, particularly since, the Russia-Ukraine crisis as well. Food prices have seen a further spike, so that the contribution of food in inflation as a whole has gone up, which is what you see on the right-hand side as well. That, the green portion indicating the contribution of food and beverages in CPI, which is sort of, in a way, moved up over the last, couple of quarters or so. So along with higher commodity prices, food prices have also been, or rather higher energy prices, food prices have also been sort of, pulling up sort of inflation as well. And of course, in more recent times, we've seen, the rupee, depreciate, quite sharply. Of course, most currencies have depreciated versus the US dollar, and probably the rupee hadn't seen such a sharp fall relative to other sort of emerging market kind of currencies as such. Of course, one of the concerns has been around, the expanding sort of, trade deficit, as well as the expectation that the current account deficit also would be fairly wide. The most recent numbers, of course, for the trade deficit are significantly higher than what we had seen even a year ago. The trade deficit about a year ago was at about, $9 to $10 billion, and now it's gone up to about, $25 odd billion. So, that along with, FII outflows, or, selling by FPIs in the equity markets, in a way has contributed to, a sort of a relatively sharp fall in the rupee. Of course, the RBI has been sort of supporting the rupee, and which is probably not, otherwise you could have seen much lower levels on the rupee, by now as such. So the expectations are that the current account deficit for this year will be, much higher. This financial year would be much higher than what we've seen over the last few years as such. So this is what the right-hand side, chart in a way indicates, the level of current account deficit that we've seen over the last few financial years. So this year, the expectation is that it would cross about 3% odd. So that's definitely an area of concern. And, the RBI has clearly over the last few days taken some additional, steps to try and, attract more flows and help sort of bridge this, deficit in a way. Quickly looking at also, RBI's estimates on inflation and growth. Obviously, on inflation, we've seen, and this is a comparison of what the expectations were or estimates were in Feb versus more recent estimates in June. So clearly, there has been a spike in the inflation estimates. And again, probably, there was a view that probably RBI was slightly behind the curve, and you saw that off cycle, policy rate hike and so on. So since then, of course, RBI is up their inflation expectations as such, and they expect probably inflation to start moderating by Q3, Q4 of the current sort of financial year, on account of probably a fall in commodity prices, slowdown in global growth, as well as actions being taken by various central banks as such. On the growth front, RBI hasn't scaled down the estimates uh, by a significant degree as such. Of course, they've been toned down a bit, but not by very significantly as such. So growth is still expected to be relatively buoyant. Of course, Q3, Q4 growth would probably slow down a bit. I think a bulk of the growth obviously is coming from the base effect in Q1, where growth would be significantly higher than what it was last year as such. And in terms of how Indian yields have moved, here we're looking at the GSEC yield curve over the last about year or so, and we are seeing that the steepness in the yield curve in a way has reduced a bit. Last year, I mean, because the yellow dotted line, the yield curve was fairly steep. Since then, we've seen a sharp jump in short-term yields. So we've seen short-term yields move up. I mean, the 1 year kind of segment, yields move up by about 200 odd basis points. Whereas at the longer end, although yields have moved up, but not as sharply. And due to this, the steepness in the yield curve, in a way, has sort of, reduced, over the last about year or so. And, from our perspective, we think, that the medium to long end of the yield curve still looks attractive, although the steepness has reduced. But still, if you look at the term spread or the additional yield that you're getting for holding, say, a 5-year or a 10-year, government bond is still higher than what it was or it has been historically. So here we are looking at, GSEC spreads, so the 5-year and 10-year spreads versus the 91-day Treasury bill, how they've moved, over the last, about almost 20 years, and what, the long-term averages as well. So as you can see, the spreads have come off, but they're still much above the long-term averages as such. So therefore, we feel that we still believe that, the 5 to 7 year segment of the yield curve looks, fairly attractive, from that point of view. And probably these spreads over a period of time should sort of, narrow down a bit further as well. And just quickly looking at corporate bonds, out here we've seen a bit of spread widening. So we've seen, particularly on the AAA and AA side, we've seen spreads sort of widen from where they were a few months ago. But AAA spreads are still below their longer term averages. So we think probably this segment still doesn't look as attractive. Of course, from a credit perspective, there's no issue as such, but purely from a spread perspective, the spreads are still below their longer term averages as such, whereas we're seeing, at least for, the AA and below rated, spreads are somewhere close to their longer term averages. So probably, that segment we think looks a little bit more attractive as compared to, the AAA segment. And finally, a quick look at how we are positioned in our balanced sort of portfolio. So this is a multi-asset strategy that we offer, or it's part of a range of multi-asset strategies that we offer. And the balanced portfolio typically has 50-50 kind of a split between equity and debt. And within equity, we invest in Indian equity, international equity as well, and of course on the fixed income side across cash, short-term, medium-term, and long-term debt. And the asset allocation is in a way actively managed, based on the views that we put out, and of course we discussed our fixed income views. So if you look at broadly how the balanced portfolio is positioned, we are underweight Indian equity. So you can see, the green portion indicates, the green bars indicate our normal or neutral allocation, and the blue bars indicate our current allocation. So if you look at our positioning in large, mid, and small cap equities, we are slightly below our neutral or normal weight. So we are slightly underweight Indian equities, whereas on the fixed income side, as I mentioned, we think the medium to long-term segment looks attractive, and we are sort of overweight out there. Whereas on the international equity side, we continue to be underweight US equities and sort of marginally overweight, Europe and emerging market equities as such. So, that's how the portfolios are positioned. And from there, I'll hand over to Lakshmi to share her thoughts I'll just stop sharing my screen. Yeah.
Thanks, Dhaval. Let me just put up my screen. I hope the screen is visible. So hi, good afternoon to all of you. And what happens in a market, especially when it's talking about the bond markets, the macros are pretty evident. And when there are two of us speaking and one has already spoken, you realize that bulk of the slides that you wanted to present is already been presented. So as Dhaval was talking, I tried to look up a couple of presentations, which I made a few days back, and I tried to put up something which will, probably give you a sense of what kind of dilemma we as money managers are facing, and that kind of ties in with the dilemma that central bankers world over are facing. So to start with, most of the macro part has already been very well articulated by Dhaval. This is, if you look at this, we are talking about Fed talking about no rate hike up until 2024. This was the narrative, about a year. This is 2021 narrative. So about a year or 15 months back, where you are talking about, the Fed FOMC or the Fed chairman saying that there's going to be no rate hike. And then the next thing you realize is that after 15 months, you have seen CPI reach where it is, and there have been relentless, rate hikes. And even as we speak, as Dhaval very well articulated, there seems to be no pause as far as the thought process of the US, Fed is concerned, because if you look at, see, every country or most countries have negative real rates, which means inflation is ruling way, way higher than where the benchmark rates are or what the rate, the consumers are earning. But in the US, if you see the inflation at 8.5, 8.6, and the 10-year benchmark at 3%, the gap in the rates in terms of what you earn vis-a-vis what you are, giving off in the form of inflation seems to be significantly higher. And that's what this chart is trying to show you, how the inflation has zoomed up in the last 12 to 15 months. It's pretty much the similar situation in the rest of the world. The yellow one is showing you, or the amber, circle, if you see, is what is showing you what is the current situation. And this is what, the blue one was where we were at the start of the year. The x-axis or the lower line is actually showing you where we are in terms of growth, and the y, is actually showing you in terms of inflation. So clearly, if you see from a growth perspective, the yellow circle is actually shifting towards the left-hand side, which means the growth is tending to get tepid, and the inflation line is growing higher, suggesting that it's a lower growth regime with a slightly higher inflation. Some economists call it stagflation, but I don't think all or, most of these countries yet qualify for a stagflation kind of a definition. So clearly, therefore, given that backdrop, Dhaval also showed it in his slide. It is a slightly different depiction of the same thing. There is clear aggressive tightening happening from the markets. There is an expectation that as early as 6 months down the line, there will be 3.4% on the FOMC or the Fed funds rate. And talking about rate hike, even today, one of the FOMC voting members as governor made a statement that don't read too much into US recession. We should be on path to tighten. 10-year benchmark there, if you see 2 years back, just before or just at the start of COVID, was under 0.5%, 0.3 to be precise, went up to a high of 3.4%. And right now it's meddling, it's somewhere in the region of 2.8 to 3%. But just imagine the kind of whipsawing. I mean, this chart, is quite a telltale sign of the kind of volatility and the unnerving nature of the markets. Of course, if statistically one were to see a standard deviation, which is that's what depicts volatility, if one were to see the volatility between fixed income and equities, clearly equity is way higher, but this also is nothing short of reasonable turbulence to grapple with from a market standpoint. However, if you look at some of the early indicators, whether it's the US real estate, whether it's the incremental housing sales which are happening, which category is selling, there is some very nascent signs. We can't read too much into it or conclude that this is what it is, because the labor market, the employment market in the US is still fairly strong. But this is something which one needs to keep watching as a cue, not conclude that there will be no more rate hikes, but clearly fodder for thought that the US real estate market seems to be on the decline. This is the consumer sentiment index, again, which market participants track pretty widely. Again, this sentiment or the index is clearly, heading on the downward side. This is where it shows you. This is the data. I think this is updated as of May end, not too far away, but clearly, again, suggesting you some cues which you need to keep in mind as an investor or as an advisor, that these are cues which are clearly bond markets are sensing. So which is why if you see in the second half of the last month, specifically last 2 weeks, bond deals, whether it's in Brazil, whether it's in China, UK, Germany, all places, including India, actually, we actually started seeing yields come down. Durable, not durable, I don't want to jump the gun right now. Probably there needs to be some more data points to conclude that. But I think this is where the markets are, the gyrations or the whipsawing movements are pretty stark and quite steep. The rate hike pace continues. Australia did back-to-back 3 rate hikes. This one is actually telling you the number of rate hikes vis-a-vis rate cuts. In 2022, 124 rate hikes have happened versus just about 4 rate cuts. And 2020, the rate cuts were 162 with just about 6 rate hikes. So clearly you are seeing a marked differentiation between the start of the COVID phase towards the phase at which, in some sense, the pandemic is morphing itself into an endemic. Again, this slide was articulated well by Dhaval. I'm not getting into it, but what you need to keep in mind, and which is where I'll show my last few slides on outlook. Dr. Michael Patra, in one of his speeches, actually says that monetary policy should actually take into inflation projections 3-4 quarters down the line. So what you're seeing on the left-hand side, my left-hand side of the chart, is the FY 2023 Q1 assumption, which is at 7.5. Should a monetary policy decision be based on today's inflation data? Well, clearly not. It has to be forward-looking. And there, if you see the trajectory of inflation is clearly headed on the way down. Well, this is premised on $105 on crude a barrel. Gold since then has come down at least 4-5%. Dollar rupee, of course, has depreciated, but crude oil prices have been down since then. So I think at the current juncture, it's a safe assumption to have that these numbers seem to, monsoons are pretty much on track. If we keep tracking those numbers, there is no substantive alarm bells right now. So I think this clearly tells you that the 5.8 on the inflation number by the end of this financial year, it's not impossible to achieve. Alongside, an infusion of liquidity which happened in the last 18 months, this is now time to actually do a liposuction or withdraw that excessive fat or that excessive liquidity which has been pumped into the system. So whether you talk about variable rate reverse repo auctions, whether you talk about CRR hikes, we've already seen one CRR hike in the month of May. Our sense is sometime in the September, after August, the next policy is September end. There's a high probability that there could be one more round of CRR hike. However, this chart clearly tells you that the surplus liquidity regime is clearly coming down. RBI is not suggesting that they are going to make the liquidity into the deficit mode, but clearly having supernormal liquidity. At peak of this entire phase, we were close to 13 trillion rupees of liquidity, or 13 lakh crores. Now that's pretty significantly high. And there is a strong case to really come down to south of 2 lakh crores, or INR 2 trillion rupees. Again, the spread chart is something which Dhaval has already covered, but again, I've shown you, visually depicted in a different manner. Clearly, these spreads are not sustainable. Some bit of the shorter end of the yield curve moving up faster than the longer end of the yield curve is already underway, even as we speak right now. And therefore, if you look at this segment, starting from the part which I have circled, if you see that entire curve, which we in our money management parlance call it the belly of the curve, that seems to be a bright spot on a risk-reward basis. And as I mentioned to you, just see, pre-May 4th. Why May 4th? Because that is when the shocker happened, the Zor Ka Jhatka Zor Se, where the rate hike happened without, your my notice or out of turn or off cycle policy hike. Now, if you see that before that, the shape of the curve was something like this, an upward sloping, which has suddenly become like this, which means the short end moved faster, way faster than the long end of the yield curve. So incrementally, if I were to deploy money on a risk-adjusted basis, there is a feel-good factor in this segment. Within this segment, specifically, we like the 5 to 7 year segment, or maybe if you have to just pick and choose one odd, it is 2026, 27, and the 28 segment. Indian real rates are way higher. A lot of people ask me this question, if US is going to keep hiking interest rates, are we going to see similar kind of pace of activity in India? Well, the answer to that is this sheet. We are not really, while the trajectory of rate hikes is likely to continue, I think the pace will be a function of what Indian dynamics are, what Indian macro, is going to portend, and not necessarily what the US pace at which the US is running. They need to jump faster. Just for jogging your memories, it's worthwhile to mention that we were among the first countries which actually started withdrawing our version of QT, which is quantitative tightening. That is the quantitative easing giving way to quantitative tightening. So if you recall, in September 2021, around the September-October time, is when Reserve Bank of India stopped buying incrementally Government of India securities. So I think we have been managing the liquidity and the rate scenario so far pretty well. So we can afford to run at our pace. We don't really need to compete with the rest of the world. The swap curve, it's a slightly technical curve, but you need to understand this, that the way you have Nifty in cash, you have Nifty in futures and options. Likewise, we also have in the Indian bond markets, the interest rate swap curve, or the OIS curve. It's called the overnight index swap curve. Now, this curve is actually telling you that there is going to be at least 2% rate hike between now and March end, which means 4.9 on the benchmark repo rate could be probably around the 7% mark. We don't really share that view. And as I said, to take you back to what Mr. Patra made a comment, if we're looking at the forward-looking inflation, which is sub 6%, I think the case for maybe the terminal repo for FY 2023, the case remains to be at closer to the 6% mark rather than the 7% mark. So in summary, to conclude, as I said, US is going to continue to hike rates. How soon they will take a breather will be a function of the incremental macro data out there. Our 10-year benchmark last month was ruling broadly. We saw a peak of 7.6, 7.65. We are at close to 7.4 right now. And looks like we are going to be in this range with a slight easing bias in the very near term as inflation outlook starts unfolding for the better. We believe that, as I said, the terminal rate at end of financial year 2023 will be closer to the 6%. I don't know if it's going to be 5.9, 6.1 or 6.2, but around that range, give or take 10 basis points, contrary to the 6.75 to 7%, which the OIS curve is indicating. In a market like this, which is discounting aggressive rate hikes, the policymakers may not really play ball to the markets. Instruments, of course, floating rate instruments look even more attractive at the current juncture, because as benchmark rates keep getting hiked, the coupons or the interest that you earn on these instruments start getting better. A word of note, but keep in mind that these are not bereft of mark-to-market risk. So while the coupon is looking good, based on the tenor, there is daily mark-to-market. So on a price point basis, even these bonds have witnessed losses. But on a relative basis to the fixed coupon bonds, they've certainly done better. So therefore, we believe that, floating rate instruments can be looked at in terms of categories in fixed income. You could look at a combination of dynamic bond funds. Dhaval mentioned the medium category, so you could participate through the medium-term funds or the targeted maturity funds. Now, targeted maturity funds are a relatively newer category to the mutual fund industry, but clearly makes a lot of sense to have some portion, like 25 to 30% of passive as part of your portfolio, and the remainder between a combination of floating rate funds, dynamic bond funds, medium-term funds, depending on what your risk appetite is. There is no one size fits all, so it's very, very important for you to touch base with your advisor, with your distributor before you take such investment decisions. So that's it from my side. I will stop here and
Thanks, Lakshmi. I think, as always, I think that was an insightful sort of, view and presentation as such. So, my thought was that probably, there are a number of questions that are coming from the audience. So we could maybe, maybe try and address those. I think got a couple of questions from Vasudev Puranik. So he's asking that is it a good time to invest lump sum in long duration funds that have a YTM of, whatever, 7.5% and above. And would this mean that 7.5% would be a guaranteed yield for remaining tenor of the bonds? I don't know if you can say that, but yeah, I think essentially the question is that is it a good time to invest in long duration funds?
So on a lighter vein, Dhaval, there is no guarantee for life, which is why we all have our life insured. So therefore, bond markets really can't offer, and certainly mutual funds can't offer any assurance or guarantee. That's number one. That's on a lighter vein. But more importantly, to your first point, lump sum investment at this juncture into long duration funds, we don't see that as a very great option or a very optimal way to deploy money in fixed income right now. We believe that utilizing a staggered way to deploy money, given the kind of volatility and incremental uncertainty unfolding on a daily basis, you are better off, as I said, on a risk reward, deploying money into medium duration funds. I'll give you an example to articulate this better. Between a 2027, for example, we have two maturity target funds, target maturity funds. One is a 2027 and one is a 2032. Today, if you ask me where my preference is on a risk-adjusted basis, my vote will go in favor of 27 for now. Because, as I mentioned, the short end has moved up so sharply, it's making this curve slightly more attractive than the long end. You could wait, yields are going to move in ranges, so you could wait it out and see how this pans out, how crude unfolds over the next weeks or so, how inflation pans out before wanting to durably deploy into the longer maturity funds.
Sure. And an additional question from him again, from Vasudev again, is that if yield to maturity and modified duration matches one's requirement, should we even bother about target maturity or those kind of funds?
It's a very, very valid question. And, Dhaval, I keep getting asked this question and thanks, for getting this, out here to the audience. It does make sense. And I'll tell you why. There is, though by and large, active has outperformed passive. I'm talking about, the fixed income that we track. We keep doing our own dynamic bond fund analysis with the benchmark. But the fact is that having some certainty element embedded in an uncertain environment makes a lot of sense. So in a passive fund like the target maturity fund, we don't churn portfolios based on interest rate outlook. It is money in, deployment out. So that's how it is. We don't really take a view what's going to happen. It's like indexing. It is like mirroring the benchmark. So there I do not have to, and I'm not supposed to take an interest rate view. And therefore, the tendency of it mitigating your interest rate risk, assuming you're doing an underlying sovereign or, quasi-sovereign portfolio, I'm keeping the credit risk aside for now, that helps you mitigate the interest rate risk. So certainly there is no doubt in my mind that in this scenario, there is or there ought to be at least out of 100 rupee deployment, don't put all 100 bucks, but at least a 1/3 of your allocation to passive funds.
Sure. Okay. And there's another question from Ram, who's asking that, why have dynamic bond funds not done well in the past 6 months?
Dynamic bond funds are not meant to be with a 6-month objective. That's number one. Yeah. B is, even after all this, I know dynamic bond funds have just about, given flattish kind of returns, subservient to, I would say, even equity, liquid funds. But the key factor to, appreciate here is just between May 4th and to date, we have seen almost 150 basis points plus jump in interest rates.
Absolutely.
So in such a short span of time, if you see such a sharp spike in interest rates, it's quite natural that even the best of the best, even liquid funds have given sub 4% returns, despite the fact that yields, the gross yields at that time were higher. So it's only mark to market is the only reason why you have seen suboptimal returns. We continue to maintain that yields have risen. Therefore, the portfolio yields are looking way more attractive right now. And if you have, gone through a nice diversified portfolio with high grade, credits as ownership, including sovereign, I think there is a case to stay invested. And most importantly, in this kind of a market scenario, look to deploy additional monies there.
Okay. Yeah, because I think that was the next question, in fact, from Japesh Thakur, that, since the interest rate cycle has started reversing, is it the best possible time to invest in debt funds, or should we wait for another 6 months? And I think probably that's what you've been alluding to as well.
Yeah,
that you really can't time it. Yeah.
No, waiting. And Dhaval, I think one more point which I missed mentioning last time was that look at the gap between the gross yield of a liquid fund vis-a-vis, say, a short-term bond fund or a dynamic bond fund, or say an ultra short-term fund. So, for example, the gap between a liquid fund with a 3-month duration cap and an ultra short-term fund with, say, a 6-month duration gap is approximately 75 to 80 basis points. It could vary, depending on what fund house is doing, what credit, but by and large, I'm talking about high grade 100% AAA portfolios. And if I, further go down, say, to dynamic bond funds, low duration funds, etc., the gap widens further to 2.5%. So therefore, trying to time an entry into these categories is something which we strongly don't recommend. We would say that staggering it, talking to your advisor and trying to figure out what best suits based on your investment tenor should be the way out.
Sure, absolutely. And then another question around, again, floating rate bond funds that, you've been talking about. Probably it may make sense to invest in floating rate funds given that interest rates are moving up. But, the question is that these funds are yielding less than liquid funds over the last 6 months. And, throw some light on why this is happening. It's a question from Nagarajan.
Yeah, so the same reason what has happened is that the supply of floating rate bonds, which is those which are issued by Government of India, it still continues. Now, what is happening is that, slightly technical, but bear with me, if you look at the fully hedged cost, so if an issuer, in this case, Government of India, is issuing a floating rate bond, why does anybody issue a floating rate bond? Because you will be getting access to funds cheaper, correct? Over the fixed rate bonds. Now, in this case, if you are taking the example of the floating rate bond and converting it into an equivalent fixed rate bond, the pricing is working out to be more expensive. So once I think government realizes there's more, you could probably see lesser issuances coming in from them. But the supply pressure is leading to, a little bit of dampening of the demand, which is why we've seen a price point correction. Specifically, the last month was one of the worst phases for floating rate bonds because there has been continuous supply. So again, as I said, it's only mark to market. There is merit in holding on to these investments. We are strongly of the view, given the fact that these are every 6-month reset instruments. So the coupon rate of these bonds, though the maturity is higher, every six months you are getting the benefit of reflecting whatever is the interest rate. So today the interest rate scenario is heading higher. So there is a 9 on 10 probability that when the bond comes for the next reset, the coupon will be higher. So continue to enjoy the carry. In the last 12 months, between a fixed rate bond and a floating rate bond, or in the last 18 months, clearly the floating rate bonds have outperformed. So our conviction in that continues, notwithstanding the near-term underperformance.
Sure. And a question from Anish is that, where do you see, I know this is a tough one, but I'll still put it out, is that where do you see US and India 10-year GSEC, peaking at approximately when? So there, it's a double whammy, so to say.
Don't crucify me for not getting the answer right at the end of this financial year, but let me try to do some sort of navigation, which is what we are supposed to be doing when we manage our portfolios. So as I mentioned, if we are expecting the terminal repo rate to be at around the 6% mark, then a 7.5 to 7.75 on the 10-year, which means closer to 7.75-ish is where this year could peak out in terms of the 10-year rates. Likewise, if in the US, US is a more difficult call because there is conflicting and contra views consistently coming out, and it's absolute chalk and cheese with respect to how many more rate hikes to happen. In fact, Fed Fund futures one time tell you aggressive rate hikes, and the other time they say as early as Jan or first quarter 2023, you start seeing rate cuts. So I think there also 3.4 to 3.5 where we saw there could be strong resistance because the foreign portfolio investors don't really mind holding on with an appreciating dollar. You see, most of the emerging market currencies have been buckling under pressure. So therefore, if 3.4 were to be the terminal repo rate, then probably somewhere around 375-ish, you could start seeing these yields headed towards. But if that is not going to be the case, I think the previous peak that we saw closer to 3.4% could well be it for the remainder of FY 2023.
Sure, great. And I think there was a question also from Dhaval Doshi in terms of when are you launching target maturity funds? But of course, you mentioned that you already have a couple of target maturity funds, 2027 and 2032.
Already have. That's right.
Yeah. You already have. Yeah. Okay. Great. And there's an interesting question that, I think somebody is saying, so Deepak is asking that he wants to block a couple of lakhs, which he doesn't need for the next 30 years. So is it the right time? 30 years, 30.
30 years.
Yeah. So is this the right time to buy 30-year government bond? The idea is to avoid reinvestment risk.
Dhaval, my honest answer to Deepak is please don't buy bonds if you have a 30-year. If you please buy equities.
Yeah, buy equities.
I think the experience will be way more gratifying. If obviously you take two things. One is past, just to ruminate and see what can the future bring in forth, and most importantly, looking at the prospects from our own country standpoint.
Yeah, absolutely.
But if that is not a solution, you can still wait it out to buy the 30-year bond, because as I said, yields have not really peaked out. So if you really are keen on buying a 30-year bond, please wait it out for some more time. I don't think there needs to be any tearing hurry to own it right now.
Sure. There's another question from Juhi in terms of what is your take on gilt funds? Is it a good time to invest in those? I think you partially addressed it in terms of, might as well go it through a staggered route rather than go all out at one go.
Yeah, I maintain that view. I think staggering should be the way out. Lump sum, I am not a big fan of doing a lump sum right now, unless you're saying that nahi kuch bhi ho jaye, I'm going to be very happy, which is, I don't see too many investors that way these days. People say, I'm coming for 1 year, and then the next day they ask me, NAV niche kyun hai? I don't see my NAV swap.
Absolutely. So another question is from Samarjit asking in terms of, you didn't talk much about short-term funds as a preferred, investment kind of given the current sort of interest rate cycle. So is there something that you feel that probably short-term funds are not looking as attractive as probably other segments?
So I would say that yes and no, because a combination of floater and dynamic will probably get you a similar kind of a trade-off, and probably in a better manner. Therefore, my preference would be towards that. Bond short-term or short-term bond funds in the industry are managed in the 1 to 3 year duration range. So they are pretty tight as far as the contours are concerned. Today's interest rate scenario warrants you to be slightly more dynamic in your thought process, and therefore my preference to a dynamic bond fund is more inclined towards a dynamic bond fund to a short-term bond fund. And as I said, to of course mitigate some bit of that risk, you top it up with combination of floaters and target maturity funds.
Sure, sure. And something that we probably didn't talk about much was the credit risk space, right? I mean, so I think there's a question on that as well in terms of what's your view on credit risk kind of funds. I think that question has come from Sameer. Yeah.
So, if we would look at these categories in fixed income as sectors, which is Government of India, state loans, corporate bonds, in that AAA, PSUs, AAA corporates, private sector and non-AAAs, I would say it's time to be overweight a combination of government and state government loans, and time to be underweight the corporate bond segment, because the spreads have compressed and how, and Dhaval, you also showed that as part of your presentation as well. There is more hands or more money chasing through few issuances, and therefore the tendency of mispricing a credit could be high. Of course, in the case of quasi-sovereign or PSUs, you don't have to worry about the credit risk, but clearly the rates are not reflecting its true sentiment. So between a PSU, a corporate bond, preference could be for a state loan. State loan and GSEC also spreads are gradually compressing. So GSEC will start looking much more. Of course, you have to keep in mind the supply side as well. But corporate bonds, while the credit environment has improved for the better, I would say the opportunities in the credit space are far too few right now. So as I said, from a top-down perspective, it makes sense to be underweight that sector right now.
Sure. And, there's another question around from Prasoon around, when are FMPs coming from Kotak? So do you plan to launch FMPs, or the focus is more on the target maturity fund? Or
target maturity funds are achieving a similar, trade-off from an investor standpoint. At the same time, it's open-ended in nature. So if the world comes to an end, somebody wants to exit, you can actually feel free to exit, though the intention is to keep it to the targeted maturity date. Therefore, from a preference standpoint, while very sparingly, depending on what tenor, etc., we might look at FMP selectively. But in general, the preference would be, so for example, to launch a corporate bond portfolio of a longer tenor, say 3 or 5 year, as and when the spreads look better, the preference would be through the FMP route, because liquidity is much lower in the corporate bond space. Whereas to do a Government of India or a state loan kind of an underlying, the preference would be to do it through the target maturity.
Sure. And a slightly more basic question from someone from Rosita. She's asking in terms of, can you explain the roll down strategy, with an example? So that will be useful, probably, not everybody. Yeah.
The roll down is very simple. Fill it, shut it, and forget it. So I am sitting in 2022 right now. Suppose I tell you, or your advisor, or you are the investor, and the mutual fund tells you that this is a 5-year roll down. What it means, in 2022, you're investing, you know that it is a 2027 maturity strategy that is being offered to you. When you go in 2000, so it's a 5-year roll down. When you go in 2023, this becomes a 4-year roll down, which is 2027 minus 23. When you go into 2024, this becomes a 3-year roll down. So effectively, what happens is there's a receding maturity in that strategy in case of a roll down. So it's as simple as calling it a passive strategy, where the fund manager doesn't take any view, but he or she has taken a view to run it like a gradually running down maturity structure. That's what roll down means.
Sure. Great. And, we've spoken a little bit about the medium end of the yield curve and that being attractive and all that. So, but in terms of an investment horizon, when one is looking at say, the target maturity funds or other sort of medium term kind of funds, what should be the investment horizon that one should sort of, consider? I think that question has come from Ranjan. Yeah.
So try to look at the duration of the portfolio. So for example, if the duration of the portfolio is about 1 year, then your holding period in that fund could be anywhere between 6 to 18 months, around that region. Likewise, if the duration of a portfolio is 2 years, your investment in that fund could be anywhere tops 12 months, 15 months to upwards of 30 months. So try to pair in the duration of the portfolio with the tenor and be in and around that. Maybe if we had this webinar 6 to 8 months back, we would say try to match it as closely. But given the fact that the market yields have run way ahead of the policy yields, it is okay to have a duration of the portfolio slightly higher than your investment.
Sure. Great. That makes sense. Another question from Ajay is that what about using RBI? Obviously, as we know, they came up with the the direct option for retail investors to buy government securities. So is that something that investors should look at or advisors should look at? What are your thoughts on that?
See, comfortable, it's sovereign risk, right? So if you're comfortable with the modus operandi, if you're comfortable with the operational part of it, go for it. It's always nice to have, a blended fixed income portfolio. But if you are the hassle-free types and you want everything, with the click of a button, then you're better off, doing it through the mutual fund route via your advisor. So there's nothing right, wrong about it. It's a great avenue. It's a great option available to directly access. So yes, if your means clearly warranted, there's no harm, going for that route as well.
Sure. And, we spoke a little bit about where somebody had asked about, investing in the 30-year G-Sec. So a related question around that is that given that, as you were saying also just now, that, yields have probably moved a little bit ahead of what policy is expected to do and so on and so forth. So, the question is that why isn't anybody coming out with or any AMC coming out with a very longer dated target maturity kind of a fund as as a means of generating, say, retirement income kind of a thing. So a 20-30 year kind of a target maturity fund.
No, it's a very, very valid thought, and we keep discussing it in the drawing board also whenever we try to think of what should be our next launch. So two things which act as a mental block. A is that if you look at the long duration funds, currently there are a handful of them. If you just go and look at their past, the past is not very encouraging. So despite the fact that the investor tells you that she is coming in for 10 years, 15 years, 20 years, human instinct to get carried away by the past, and they have been among the worst performing category funds. So that's a big dampener, and that dissuades further investment. That category is not getting flows. In fact, there's a net outflow. So that's number one. Number two is, it is our general assumption that when somebody is coming with a goal-linked mind, in this case, retirement is a goal, she is doing the asset allocation with their advisor, or if they know it all, then they're doing it by themselves. And they are using, say, mutual funds as a vehicle to deploy their view. So therefore, trying to offer specific goal-linked funds is not really kicked off or taken off that very prominently in a country like India. Number one. And number two, other most important, yes, we will certainly launch long duration strategies. There might be a timing gap, but right now, as I said, the penchant or appetite for these funds are not there. And second is, we believe for achieving these kind of goals, a hybrid fund is way better suited. Which has marginal equity ranging from 5-10% lower side to 20-25% higher side. These kind of hybrid funds are available in the industry. Please do your due diligence. We believe that they are a way more potent way to achieve your milestone linked plans, including retirement solutions.
Sure, great. And another interesting question which we spoke of, which you spoke of a little bit, is a roll down strategy, right? So the question is from Roshan, is that how can a roll down strategy fail?
How can
under what scenario fail or not do so well? Yeah.
Fail, it can fail in the sense only if there is going to be a roaring dip in interest rates. It's going to be a massive rate cut kind of a scenario, which we saw starting May 2020. In that kind of a scenario, because your duration is receding in nature, you are really not wanting to, or you really cannot increase the duration of the portfolio despite the fact that rates are falling. So in those kind of scenarios, clearly these roll down strategies can underperform. We did see that if you pick up a track record of roll down strategies at a time when RBI was in the rate cutting spree, starting April, May 2020, and I'm talking about 1.5, 2 years back, you clearly will see these roll down strategies have underperformed actively managed funds. So in those kind of scenario, we currently are not in that kind of a scenario. So therefore, as I said, choosing a combination and more specifically choosing, a target maturity fund kind of a concept works well. But as I said, don't put all your eggs in one basket, because there's always a risk of you going wrong.
Sure. And I'm not too sure if you can respond to this, but there's a question around what's your advice on USD global corporate bonds, or DM versus EM and things like that. Would you want to respond to that, or?
So one is, there has been, a massive compression and then spread widening also out there. So there were, at a point in time, the US high yield bonds were trading way, way lower. But with interest rates rising and liquidity becoming far more scarce, those bonds, obviously yields are way higher, spreads have started widening. But one, thing which I want to add on to this, as an Indian investor, if you want to access markets offshore, then do look at offshore bonds or dollar bonds of Indian issuers. So if you are comfortable with a particular credit today, there are amazing opportunities. And obviously we can't take names of issuers, but please do your homework. You will actually realize, or the Morningstar team can actually help you out. Please go through the bonds of some NBFCs, some banks in India, which have dollar bonds outside. You'll be surprised at the kind of yields that are available. So those could be a great opportunity if you want to do some diversification.
Yeah, great. And again, you spoke a little bit about the OIS curve and so on and so forth, right? So there's a slightly more fundamental question from Sagar, is that where do you get interest swap data for Indian markets and stuff?
Go to ccILindia.com, and in that, click on the IRS or FRS page, and that will give you all the data, both present and the historical.
Sure. Right. I think there are a number of questions, but many of them have been answered earlier. There's one question from Avin in terms of, do you see India being added to the global bond index? Of course, this is something that's been of debate for quite some time now. So your thoughts on that?
In a lighter way, if I had to do it, I would have done it as of yesterday, but hey, I'm not doing it. And most importantly, I think it is still some time away, because, while it could be the need of the hour, given the fact that, our foreign exchange reserves have depleted, but there's already been a rupee redux attempt, and we've seen some measures announced by the Reserve Bank of India to cool off the rupee. I think those measures could be it for now. At least I'm not aware, I'm not reading anything in media which were to suggest that the inclusion is anytime going to happen in the near future.
Sure. So I think that's broadly about it. I think like I said, there are a few questions which we have addressed earlier, and we are out of time as well. So I think, Lakshmi, it's been great having you here as always. And thanks for patiently answering, so many questions. I think we had a fairly engaging audience, and a lot of questions came through. So I think, thanks to the audience as well for posing those questions. So just request, sorry, please.
No, that's it. Great. Thank you so much.
Sure. So just request everybody to just stay on for a minute. There's a poll that will come up, so we'll request you. We'd love to hear your feedback. So do complete the poll, before you leave. But Lakshmi, I think we can leave, right?
Yes, great. Thanks. Great. Thank you so much. Bye.
Thanks a lot. Thanks.